Traders Corner is brought to you by IG.
Welcome to Traders Corner. As always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, I know tomorrow's futures closeout cannot come soon enough for you, and we'll discuss that in a moment. But let's start off with another cyanide cherry in your trading Sunday, and that is the long position you took on Investec last week, and it hasn't worked out.
No, unfortunately not. It hasn't worked out. We were stopped out of this trade on Friday of last week, and we put it on Tuesday for last week's show. So if we have a look now, the chart of Investec is up on the screen at the moment. What I'd identified last week was that the stock has really been pretty much in a sideways trading range, and you can see these Bollinger Bands quite clearly illustrated here. And Bollinger Bands are useful to use in a sideways trading stock or a sideways trading market because they don't work well in a trending market, but they do work well in a sideways choppy market like this. And what I'd identified here was that this stock price had been ping-ponging off the upper and lower Bollinger Bands. Now, the way the Bollinger Band really works is that middle line there is essentially a 20-day moving average, and then the outer two lines are two standard deviations away from that 20-day moving average. And it works quite well in a sideways trending stock like here. And what I looked at last week for the show was that it had got to that bottom Bollinger Band, it had reversed up, it had broken the downtrend, it had done all the right things. It was coming up off of oversold levels. So I took that as my cue to go long, thinking we'd get a rally back up to about, I was looking for a move to about 107, maybe 108 Rand here. And that would have been a nice quick little trade for us. However, unfortunately, what's happened is the markets have gone into risk-off mode quite aggressively over the last couple of days. And you can see that that break up in Investec has failed, and it's come back down. And now my stop loss was below the lows of that reversal last week, and that has been taken out. So we went long of 1,300 CFDs at 102 Rand 81 with a stop loss at 100 Rand and 71 cents. Unfortunately, it was stopped out. Because I don't use automatic stop losses, I use manual stop losses. There was a bit of slippage here. We got stopped out at Friday's close of 99 Rand 71 in the closing auction on Friday. And that resulted in a loss of 4,550 Rand after all costs have been taken into account. So very frustrating. But look, on the bright side, the stop loss did save us from losing more money, which is where we would be sitting now. Yeah,
and unfortunately, Investec's sort of on the wrong side of everything because it's, I suppose, exposed to emerging markets and also to the UK market. Of course, now the Brexit, the Leave camp seems to be pulling ahead, and that's really spooking markets.
Correct, and that's, in retrospect, I mean, you could say that was, I think it's unfortunate that the Leave camp moving ahead has happened in the last couple of days, really. It is what it is. We went into the trade with our eyes open. It didn't work. We move on.
Yeah. Okay. Well, not entirely. So we're going to go and revisit the trade that has been your albatross for the past couple of months, and that was the options position. Thank goodness it's closed out this week because also this has not worked out.
Yeah, I mean, this has been immensely frustrating. It really, really has been immensely frustrating. I know these options structures that I do for the show are quite complicated. I've been told that many, many times. And I know there's probably many viewers sitting there in their armchairs at home now saying, well, Garth, you do all these fancy, complicated things and they don't seem to often work out. And this one, in fact, is now costing us a little bit of money with what's happened. Why bother? I still believe that these structures are worth putting on. Net over the years, we have made a bit of money out of them, or we've made money by trading around them. But this particular one for this June futures closeout has really not been good for us. And I'll explain why. Look, we put the structure on in February of this year. So it was quite a long time ago. At that stage, the markets were not looking good. It was really, I came into this market this year fairly convinced that we were starting a bear market, and all the technicals seemed to suggest that. But the market has moved higher over the last number of months. Part of that has been driven by the fact that we've got this SAB Miller corporate action, which has propelled the market, probably added another 2.5, maybe even 3,000 points onto the value of the top 40. So it's kind of changed the game quite a lot for us. Now, when I put that structure on, at that stage, market was around about 44,000 in February, and I was looking for the market. Basically, the structure we put on was a put option which was long at 43,000. So below 43,000, we would make money on that structure. I then sold away upside because at that point in time, I felt selling out the money call, in this case I sold short a 47,000 strike call in order to receive a bit of premium on the structure. It was so far away at that stage, I thought, the chances of us going to 47,000 look really, really slim. Anyway, we fast forward a couple of months and you can see that we've tested that level on a number of occasions. And unfortunately, the way the payoff of this structure works, you can see that from 47,000 down to 43,000, we're basically in a neutral position. Below 43,000, we would make good money on the structure. However, above 47,000, we lose money on that option structure. And I've been aware of that the whole time, and you can see that it's flirted with this 47,000 level quite a few times over the last number of months. Now, at the end of May, we saw a breakout through that 47,000 level, which at that stage looked like quite a confirmed and convincing break. So I thought, well, I don't want to have open-ended risk at that point, because essentially what it means is I'm naked short from 47,000 if the market goes up.
Which was entirely contrary to the whole, I suppose, point of having an option structure to hedge yourself.
Well, exactly. I mean, we don't go into these things expecting to lose money. At worst, we hope to, come out even. And at best, we hope to actually make some decent money out of them. This one's gone wrong. And when it started to break above 47,000 at the end of May, I then decided I need to hedge that risk out. So I went long of one top 40 future at 47,241. And the market rallied, and at that stage, I thought, okay, well, it's fine. I've done the right thing. Of course, fast forward now, again, another 3 weeks or so, now we've got a market that's come aggressively lower and is sharply down again today. So what I then end up having to do is once it comes back below 47,000, then I have to take that hedge off, right? Because I don't want to be exposed. So now I had to sell that that one top 40 future. And because of the sharp gap down on the market yesterday, that was Monday, we gapped down 400 points at the open on
so past your stop loss, in other words?
Well, yeah, basically not a stop loss, but straight below the level where we went into the trade and right underneath. So it ended up that we now lose 5,410 Rand. So, of course, I'm tearing my hair out at this point in time. Nevertheless, the futures close out is tomorrow. It's Wednesday, the 15th of June. And then this thing will finally be closed once and for all, and we don't have to worry about it again. And I can't tell you how excited I am for that day to come.
I'm sure all your appliances and your desk are probably quite pleased too, because I imagine that they've been taking a bit of a battering.
Yeah, I used to be known in my previous corporate life for the Mackenzie desk slap, and the Mackenzie desk slap has been coming out a lot recently.
I suppose, tomorrow, if the market had to tumble, I don't know, 4,000 points, then, all might be forgiven, but it's not going to happen. So you've lost money on the long position, which was the hedge, and you're unlikely to make any money because that's in a neutral position for you. Okay.
It's a big mess.
Yeah, basically. But you would do it again.
You would
do the option structure, maybe not quite the same way.
Not this, but yeah, I would do these. I will continue to do these option structures. Remember, they generally have a bearish bias in that I look to put them on to give us downside participation without a lot of risk on the upside. And I still continue to believe that it's a good strategy to employ going forward. The reason we haven't really done well out of them in the past is because the market had been trending up until the middle of 2014, and now for 2 years, really, the market's been mostly going sideways. We need a weak market for these things to make money. And I'm convinced that there will come a time where we will actually make money out of these option structures, and we'll make good money. So we could be making good profits while the market is falling in that sort of situation. Just we haven't had a great deal of luck with them in the past. But I still think I will continue to employ these strategies going forward.
Yeah. Well, I suppose it's all a learning curve, Garth, if nothing else. So now let's have a look at those markets, because they do seem to be very nervous in the last couple of days. And I wonder if that nervousness is going to not play out in a sell-off, or if it's going to kind of suddenly reverse.
Yeah, I want to have a look at the bigger picture and look at some of these bigger global indices. We always look at the S&P 500, and that's a bit boring. So I've chosen a couple of different ones, but also that give us very broad market overview. So the first one is the MSCI World. Now, what I use to actually track this is an ETF, which is the URTH is the code. It trades in New York. You can see the trade of this ETF here. And this really mimics the performance of the MSCI World Index. Now, this is a weekly chart. So each candlestick pattern that you see here represents 1 week worth of trade. And this goes back to the middle of 2013. Now, what's quite interesting here is the fact that earlier this year I said there was a head and shoulders pattern here and it was looking vulnerable. Now, we've had this big rally from February to where we are now. And the question, that head and shoulders becomes a bit questionable. But up at this level, you can see there's a very significant area of lateral resistance here where the market's been battling to break above. There's been selling pressure evident up at these higher levels recently. Also, there's negative divergence on the weekly stochastic over here. So that, to me, suggests that this market is probably vulnerable to another further pullback from these levels. If, however, we break above that blue line, that resistance there, which is at a level of 72 on this ETF, well, then, of course, I'd have to change my mind. But and that would be a bullish break. But as I sit here right now and I look at this, that, to me, looks quite vulnerable for a move to the downside.
Okay, I mean, that's a very broad picture of the world. So if you had to hone it down to some particular areas, I know you want to have a look at Europe and the Euro Stoxx 600.
Yeah, Europe is, for me, very interesting at the moment because Europe is kind of underperforming, and particularly underperforming the US markets. The US is doing okay. The S&P 500 is not that far away from all-time highs. But the European markets are struggling, and this is the Stoxx 600 Europe index. So 600 stocks that comprise of mid, small, and large cap stocks in Europe. And this goes all the way back to 2009, to the start of the bull market. And you can see very clear upward trend identified there through the various lows over the last couple of years. But in December last year, we broke down below that upward trend. And now we've got this lateral support here at a level of 300 on the Stoxx 600. And there's a potential head and shoulders pattern that is forming here. Also, this, to me, this sort of consolidation that we're now seeing underneath that prior uptrend, just to me looks like a sort of almost a continuation pattern within a new downtrend. Also, notice the 50-week moving average that has begun to roll over and is pointing downwards. So to me, I think we've got to be careful here. This does look vulnerable to a potential move back down to this 300 area. And that would be the neckline of that head and shoulders pattern. And then from there, we'll need to see whether it breaks the neckline or not.
I mean, that would be, about a 10% correction? Or
yeah, from the current area, that would be about a 10% correction to get back down to that neckline. And it would essentially mean we'd be going back to the February lows.
And the Euro Stoxx 50, is it different at all?
It's fairly similar sort of setup. I think here the head and shoulders pattern is just a little bit more developed. Again, it goes back to 2009. It is a weekly chart. And you can see the well-defined upward trend that goes back to 2009 there. That trend was broken in December last year. And the market's really been consolidating underneath both the 200-week moving average there as well as the downward sloping 50-week moving average. And again, this looks to me like a bit of a sort of almost like a little rising wedge pattern, which is vulnerable to breaking to the downside. And we've also got a head and shoulders pattern there evident.
And very quickly, let's have a quick look at the UK market because that's key, and then the VIX, which is also interesting.
So the FTSE 100 is interesting because we've got the Brexit vote coming up next week, Thursday, on the 23rd of June. And it's very much on a knife edge at the moment as to whether they will stay or go out of the European Union. And here, your FTSE 100 also is basically very, very on a knife edge at the moment. In fact, while we've been recording the show now, it's been breaking down below this support level. 60.40 is the level, and a break below that 60.40 would be quite a bearish break for the FTSE 100. It will almost be like falling off a cliff over there. And that is, in fact, happening while we record the show. So it does look like there's a bearish break happening there on the FTSE.
And the one thing maybe we should have been buying was the VIX.
Yeah, in retrospect, the VIX was giving us a clue recently. There was, if you have a look, there's actually positive divergence on your stochastic of the VIX. So the stochastic makes a higher low, and yet this VIX made a lower low. However, it was always looking as if it might be primed for a break higher, and now suddenly over the last 2 trading days, we've seen the VIX breaking significantly higher through a level of resistance at about 16.5 on the VIX. That's a massive break to the upside, and high volatility comes with fear in the markets.
Yeah, well, I mean, I noticed it yesterday. I thought, can that be correct? 16% up in one day, and yes.
Yes, it can. And volatility, the VIX can move around very, very violently when the markets becomes afraid.
Yeah, maybe we should have a little show about trading the VIX at some point in the future, guys. Yeah. But we're not going to have time this evening to discuss it further. But just let's see now the effects of that Investec long and the option structure, how the devastation it has wrought on your portfolio.
Yeah, look, I mean, last week we were up nearly 11% for the year to date. You can see now we're only up 7.7%. So it hasn't been a very good week. There's the loss on Investec, the loss that we took on the top 40. It's not great. As things stand right now, all we've got is the option structure, which expires tomorrow on the closeout, and then we'll be totally in cash for next week's show.
And then to end off your next courses and also those of your colleague Andrew Todd.
Yes, so these are the courses we've got coming up in July. My colleague Andrew Todd runs a very good top 40 trading course, and he'll be doing that on the 2nd of July. And then I'm running my Understanding CFDs course on the 21st of July and a high probability trading course on the 23rd of July. So anyone that would like information on these courses, please email me, garth@traderscorner.co.za, and I'll send you all the details.
Great, Garth. We'll leave it there. Thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.
Traders Corner is brought to you by IG.